Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 27th of November. In the last week, which was a shortened week in America, there was really only 3.5 sessions with Thanksgiving during the week. We saw the trends that have prevailed since the US election continue and continue with some degree of gusto as well. Now, those trends, both in the upwards direction and the downwards direction, have now reached uh, some real extremes. And so you'd have to expect that in the next few days, we may see at least a partial retracement because some of these moves, as you'll see from the charts, have really been quite extraordinary and they're moves that have not been seen in 20 or 30 years in some instances. So that's sort of where we're at the moment, but it really does confirm that a number of things have changed since the US election, and we're going to see some new trends emerge than what appeared likely just a month or so ago. So let's take a look at the markets. It's going to be a shorter video this week because it's really just a continuation of the pattern that we've seen for the last few weeks. I think I've made all those key points over the last couple of weekend videos. So really this is just a bit of a recap. So the S&P ended up rising by 31 points on the week. And as I said, the rises, of which there have been more rises than declines. The most notable decline, of course, is in precious metals. Have now reached really quite massive extremes of overbought and oversold, and therefore we should expect some sort of partial retracement quite soon. The surging US dollar, which the reasons I explained for that last week, is going to start to be an issue for multinational earnings when you translate them back into US dollars. So that's going to be a bit of an issue for the market, and I think that's one of the reasons that we will probably see a little bit of a cooling off in the short term in the US dollar. The huge sector rotations that we've seen in the last 2 or 3 weeks have continued and are probably set to continue on a medium to longer term basis. The market is very much focused on the positives that are stemming from the Trump election victory and ignoring the potential negatives that are out there. And when everybody starts to get of the same opinion, then inevitably markets are close to a bit of a short-term turning point. And at the moment, the consensus is just wildly all to one side of the boat. And therefore, I think that's why we'll see some partial retracement. But I think those retracements really should be viewed as buying opportunities. As you'll see, both technically and fundamentally, there is a strong case to be made for the US stock indices moving higher from here. That is the path of least resistance. That is the overwhelming odds, both fundamentally and technically. So therefore, buying pullbacks, I would see as an opportunity. And when you consider just how strong the market has been in the last 4 or 5 years, when sentiment has been negative, this has been the most hated bull market in history, yet the market has still managed to go up. What's going to happen to the market if sentiment starts to change? Now, we've seen a bit of a shift in sentiment already in the 3 weeks since the US election, and look at what the market has done. It's almost gone vertical. So it's quite extraordinary, and most bull markets finish with a real burst of euphoria that might last for 6 months, a year, possibly even 18 months. And we haven't seen that. And that's what I've consistently said over the last couple of years, that until we see a really positive sentiment and we start to see a much higher level of commitment of money to the market, that we're nowhere near a top. And to a degree, we're still in that position. We might now be at the start of that final surge where sentiment shifts and a lot more money finds its way into the market and the US indices really start to surge. Time will tell on that. But I feel very comfortable that we are not close to a long-term top. Yes, we could still get 10, 15% corrections. There's plenty of triggers out there that could cause that. Particularly throughout Europe and particularly in the bond market, But what I'm talking about is a long-term top in the stock market that then leads into an extended bear market period. And the conditions haven't been in place for many, many years and still aren't in place at this point in time. So just think about what the market might do if the sentiment does start to turn positive. And one of the things about stock markets is that they're a reflection of human psychology, and the trends tend to spiral in one direction or the other. And so strength has a tendency to feed on itself. And I think that's still potentially the wild card for the markets to the upside. Technically, we've seen a breakout now in all the main indices in the US stock market. The Russell, the Dow Transports, which is really important. They had been lagging. The Russell looked like it was rolling over and falling into a downtrend. It just snapped back out of that, and when you see the chart, it's just quite extraordinary the way the Russell 2000 small cap index has performed. And even the really small caps, there's an index in America which reflects micro caps, so not just small caps, but the really small stocks, and it's done remarkably well also. So there's tremendous breadth in this rally. It's really quite amazing, and it's a case of strength is breeding more strength. At the moment, the sentiment hasn't really turned positive yet, and that's why I think if and when it does, you could see this market surge quite a long way yet. The winners so far in the last 3 weeks have very much been, and I'm talking the American market here, the winners have been very much the financials, industrials, infrastructure stocks, and the relative losers have been the stocks that were purchased on a yield basis. So all of those high-yielding, lower growth stocks have been punished, and we've seen that in Australia as well. I spoke about that last week, and also technology stocks have been a bit of a relative loser. They've not really gone down that much, but they've just pretty much stayed stable. Now, I'm not perturbed by that because I think technology is an amazing long-term theme. I think there's going to be a huge amount of money to be made out of all the various forms of technology and technology disruptors. But the reality is that for the financials to surge as they have, and a lot of the industrials to surge, the money had to come from somewhere. And a lot of this technology stocks, Google and Amazon and Facebook and Netflix and all those stocks were trading on pretty high PEs. And so some money has come out of technology to flow into the banking sector. That is not a negative for technology. It's just a bit of a reality of the market dynamic. Don't worry about technology. They're going to continue to be terrific winners for a long period of time to come. Importantly, there's the US dollar index. Over the last 3 years, you can see that we had a major surge off around the 80 mark. We went into this extended sideways band for around 18 months between 90, 92 and 100, and you can see now that clearly the US dollar index has broken out. That has positive implications, but it also has negative implications as well. So, it's the old story. Markets can't move too quickly in one direction. Otherwise, you just reach extremes that are going to reverse. And the more that the market continues in the one direction, the more significant that partial reversal will be. Let's jump in and take a look at some charts. And I'll start this time with the Russell 2000. If you remember, if we go back to here we were the 27th and 28th of October, and that was when I pointed to the fact that the Russell had broken down. We'd formed a new lower low and lower high. The moving averages were rolling over, and so therefore you needed to be cautious. So that was the 28th of October. The 3rd of November, just a few days later, it turned out to be the low point, and then the market has just turned around, and you can just see the absolutely stunning rise that's occurred in the Russell 2000. It's gone from around 1150 to now be at 1350. That's a massive rise, and it's basically new all-time highs. Now, there is a bit of a megaphone pattern that had developed here, and if we extend that out, then you can see that the Russell is going to be running into some significant resistance fairly soon. Now, it's not to say that this time round it's going to come all the way back down to the bottom of this pattern. We could end up with a breakout, but just bear in mind that these markets have run very hard, very fast, and so I wouldn't be chasing into these trends at the moment. Let's look at the NASDAQ. So the NASDAQ, you can see, has been really quite modest. That's reflecting the fact that technology stocks have had the lid kept on them because of the money rotation into financials in particular. Also because biotechs have continued to underperform as well, and I'll probably elaborate on that a bit more next week. So the NASDAQ, relatively speaking, underperforming, but it's still pretty close to its all-time highs. It's within a few points, so it's not like there's any particular problem there. And finally, let's look at the S&P. Let's look on the big picture first. So there's the monthly chart, 2009 here, the lows, and you can see it's been an amazing surge. We're now in what is probably the fifth leg to the upside. The third leg lasted from October 2011 to around June 2015. So it ran for nearly 3.5 years. This part of the next leg, and what is quite possibly the final leg, started in February of this year. This fifth leg could easily run for a couple of years. So, you know, there could be another year, 18 months, possibly even 2 years if Trump is able to achieve economically what he set out to do. If these corporate tax cuts really do work and all the infrastructure spending really does work. So you don't want to be, whilst you need to be a little bit cautious on the market because it is at an extreme, you don't want to be going negative on the market because this could run for quite some time yet. And as I said at the start, we haven't seen that euphoric blow-off phase. We haven't seen sentiment turn really positive. And it's almost never does the market form a major long-term top until you get those sort of conditions. Turning to Aussie stocks now, the Aussie dollar was higher to around 74.3. That was just a little bit of cooling off of the US dollar in the last 24, 48 hours. Our index, for the record, you know that I think it's pretty much a meaningless exercise following the Australian index. Higher by just a tick under 150 points on the week, and all sectors participated except gold, of course, for obvious reasons that we'll get to in a minute. The high PE trade is still struggling. All the stocks, the Ramsay Healthcares, the Domino Pizzas, Cochlear, carsales.com, realestate.com, all those high PE stocks that are also really solid growth stocks. The PE part of it is just being derated, and most of those stocks are off at least 20%, and that's a global phenomenon. So that's still played out. I suspect it's probably mostly played out for these stocks now, and so we're starting to see a few nice little rebounds, and so there's been a little bit of fishing that we've been able to do, and members have been able to pick up on a few of those in the last week or two. Resource juniors are really starting to receive a lot more attention now in the Australian market, but just be careful. This is not something where the rising tide's going to lift all boats. There's still a lot of really poor quality resource juniors out there. We're late in the cycle for some of these. Just lithium is hot, but just bear in mind that, as with all other commodities, as we've seen over the last 4 or 5 years, they get overinvested, and a couple of years down the track, we get a massive response on the supply side. The prices fall, as we saw with iron ore and coal and oil, and and a lot of people get burnt at the end buying into the hot sectors at the end of the cycle. So just be careful about what you're going into. So let's look now at precious metals. Gold was down by another $27. We had that break of 1300 when Trump was elected, and that was of course amplified a bit by speculative selling in the futures market. We then got another break of 1200. As members would know, I've been saying that the level of speculative long contracts in the futures market was still at an uncomfortably high level despite the sell-off down through $1,300, and that really we needed to see that wash out, and that's exactly what happened when we broke 1200. So 1200 was a technical trigger, and that caused a lot of the futures longs to be liquidated. We haven't seen the data on that yet to see exactly what the impact was, but I would expect to see that the speculative longs have been cut down quite a bit. There's been quite a lot of selling in the ETF market now. Gold has reached an exact 61.8% retracement of the gains since the start of the year. So from a technical point of view, this is an interesting level down here now. We did see silver steady a bit on Friday. So silver actually went up, whereas gold struggled a bit. So that's interesting, to say the least. Are stocks forming a base? Possibly. I'm just really, in terms of the short term, I'm keeping a very open mind on precious metals. It could go lower in the short term. Doesn't change the longer term at all. My position is still firmly bullish. There are just too many reasons why we are going to end up in some sort of financial market panic, which will be very positive, and or inflation. So in the short term, the rising US dollar is a negative, but that has its limitations because it causes other problems for the American economy. But definitely with the rising US dollar, and we've just broken out, so you have to think that the US dollar is going to trend a bit higher from here. I think it would be naive not to expect that. So we're going to continue to have a bit of a negative downward pressure on the gold price. And I think for gold to start to do well again, we require one of two things: inflation or fear. And to me, both of those are a given. We just don't know exactly when that's going to happen. Clearly it's not only Trump, it's before the US election, both Europe and Japan were making noises about moving more to fiscal stimulus instead of monetary stimulus. And that inevitably means that there's got to be a pickup in inflation because you're putting money directly into the economy, not putting it indirectly in through the banks where it got stuck. And that's why we haven't seen inflation in the last 5 years, because it was all about monetary policy. But now with fiscal policy being the approach that central banks are taking, it's almost a given that we're going to see inflation. And I think there are so many triggers out there. You've got the Italian referendum, you've got the elections in France, you've got the European banking system, which is absolutely on its knees. That's a disaster territory. There are just so many things that could go wrong that I can't believe that one or two of them will not trigger some sort of financial fear, and that'll be very positive for gold. But in the absence of inflation or fear, then it's hard to see gold really going anywhere in the short term. But let me reiterate again, my view has not changed on gold one little bit in the longer term. So the answer to what you should be doing is just about sensible balance. I think there's a very strong case to have some gold exposure, but don't overdo it. There are plenty of other sectors at the moment that are running and are worthy of having some of your money. Let's just look at the gold sector. So we'll start with silver. So you can see a little bit of a rise on Friday night in silver. Now, it's definitely a short-term downtrend, but we are oversold, and you can see silver ticked up on Friday night, Whereas you compare that to, this is the daily chart on gold, you can see we still formed a lower low. Now, you can see that the 61.8% retracement of the run from where we started in December of last year clicked in at 1173, and we hit a low of 1172 on Friday night, and you can see bounced about $10. So gold exceedingly oversold now. If we look at that on a weekly chart, you can see the same impact there. So no reversal yet, but we're certainly at a support level where a reversal would make sense. So watching that one fairly closely. And this is GDX. The 61.8% retracement on GDX comes in at just a tick under $20. At the moment, we haven't quite got there. With the lows are around about this 2013 area, so we're only about 20 or 30 cents off the lows on GDX index. But let's see how things play out. Don't try and be a hero in the precious metals sector. Have some reasonable balance in there, but as I said, don't overdo it. Turning to other commodities, copper was strongly higher to $2.62, and that's despite, of course, the US dollar moving higher. So copper being very, very impressive, and you'd have to think there's a degree of speculation going on in the copper market. We are looking down the barrel of a supply deficit in 2018, and I think that's unavoidable because you just can't bring new supply on quickly enough. So that supply deficit was going to happen anyway. This is not something that's just suddenly arisen in the last few weeks. We've been heading towards a supply deficit for the last couple of years. So that is a positive for copper stocks, and we're certainly seeing some positives there. Crude oil managed to go a little bit higher also, despite the US dollar, and that's a bit of an anticipation of a positive OPEC meeting. So we finished around 46. There's the spot copper chart. You can see it's been on an absolute tear since the end of October, where it was down around $2.10. Now we're at $2.62. So a huge rise in copper. So to wrap it up, it's vital not to get locked into a view, and I've been saying this over and over and over again. Yes, you can have an opinion, and I think it's unavoidable that you have an opinion, but for goodness sake, don't get locked into that opinion. Be prepared to change it, and make changes to your portfolio accordingly. The financial world is changing very quickly, and it's changing a lot, and that's why you need to be flexible. We're going to see the acceleration of technological disruption. I think that's an absolute given, and these are game changers. These make industries that have been global dominators almost obsolete in a relatively short space of time. So you've got to accept that things are changing in financial markets very, very quickly. You've also got the great central bank experiment and how that might play out with all this monetary stimulus that we've got and all this debt that we've now got, and we appear set to get a lot more debt. So how is that all going to play out? No one has any idea, and anyone who tries to tell you that they do know how this is going to play out is just kidding themselves and you. So we don't know how this is going to play out, and so therefore you need to remain flexible. The other key dynamic that's changing things as well is, of course, the protest vote that we've seen with Brexit, with Trump, with Australia, with Malcolm Turnbull almost losing, and I think we're going to see some significant disruption in both the Italian election, which comes up very, very soon, might just be in the next week or so, and then also, of course, the French election. If the right-wing parties can gain power in France, then there's going to be disruption in Europe for sure and certain, and that would be absolutely massive for financial markets. So we don't know the result of all these things, but we just know that they have the potential to cause both hugely positive and also hugely negative implications for markets. you just need to stay grounded in your thinking. Don't panic. Don't get overly bullish. Certainly don't fall into line with the crowd and chase the hot sectors. Just stay grounded and respond to the facts as they unfold. So I've mentioned those flashpoints. And of course, we've also got the impact of a long-term bond market reversal. We had a bull market in bonds and a bear market in bond yields for 35 years. Yields fell from around 17 or 18% down to basically negative yields. That has now changed, and we're heading now into a new cycle of yield rises and bond market falls. The only thing that we don't know is what is going to be the speed and the nature of that. If by some miracle the powers that be can manage to control that bond readjustment in an orderly fashion, then we scrape through, and the bond market is not a major factor. I find it hard to believe that's the case. I think when you've got a financial system around the world that is stretched and as distorted as it is, that it makes it incredibly unlikely that this unwinding will be orderly. However, I wouldn't write off that possibility. And at the moment, the market is just looking at all the positives, and that's why the US market is surging as it has. So that's what's coming down the pipeline at us. We'll see how it unfolds. Excuse me, and just respond accordingly. Just a few thoughts to finish off on. If Trump can manage to pull off his tax cuts from 35% down to 20%, then JP Morgan has estimated that would lead to a rise of $15 in average corporate earnings in America. And if you multiply that $15 extra earnings on top of the current, which I think is around, the average for the S&P is around 128, I think at the moment is the current estimate. If you can add another $15 on top of that, and then you multiply that by the PE ratio of the market, which at the moment is about 17.5, then that takes you to at least 2,400 points on the S&P, 24 to 2450, depending on your assumptions. Well, that's another 10-12% up from where we are. So just from a fundamental point of view, it's not out of the question that the US market can't continue to surge. And that's why I think it's quite possible that we might see a very positive stock market environment in 2017. What if OPEC can do a deal? I don't have a great deal of confidence about that, but what if they can? Then oil would break $50 to the upside almost certainly. And if oil is going up, then stock markets are going up. So there's another positive for stock markets. The bottom line is that we can never know for sure what's going to happen. And so therefore it's about positioning and balance. And I know I rabbit on ad nauseum about this, but it's just so important. You cannot afford to take a big position in any one particular sector or stock because you just don't know what's going to happen. Now, this is not, I'm not preaching diversification here in the normal way, because to me that's an old hat strategy that is going to underperform drastically. What I'm talking about is diversification amongst the sectors that are doing well, that have the tailwinds. So just diversify amongst the winners, if you like, and don't get too heavy in any one sector or with any one stock, and be responsive to the changes in the market. And if you do that, then I think you've probably got a pretty good future in the stock market. Buy pullbacks in established uptrends at the moment, because that is what is, and you should stay with it until it proves otherwise. And we're now seasonally at a time where we often get a good run into the end of the year. So that's wraps it up for this week. There's my contact details for non-members, and we've got another fascinating week ahead of us. Cheers.